Before we get started, we have our usual icebreaker question. Imagine Santa is a company. That's that time of the year. And my question is like, where would this item fall out? You have to tell me whether it's on the assets, abilities, or equity.
Wait,
Yes,
wait, wait. Hold on. I
yeah.
think Santa himself should be a liability to the company because he drives recklessly and lands on roofs.
Love that. I think Santa is a liability coverage.
Coverage, yes.
Although he would be a founder, right? He's founder. So Santa's going to have founder's equity in the company. But he definitely needs a good liability coverage. I agree with you. Sleigh and reindeers. Would that be an asset, liability, or equity?
Very good asset.
Asset.
Right on. One more. Elf payroll payable. Is that asset, liability, or equity?
Liability.
Yes. You guys are really good.
Hello, everyone. Merry Christmas and happy holidays. Welcome to episode 44. Since it's the end of the quarter and end of the year for some companies, we thought it is fitting to do an episode around financial fundamentals for engineers. Over to you, Asanka.
Why do people talk about OPEX and CAPEX? Why does it matter?
Yeah, I can probably try. I'm not an expert like you, but based on my understanding, the easy way to explain is it's about your expense, whether you wanted to uh, immediately affect versus stretching it over time. So you have the benefit of time. There are so many other things that impact, like your taxation and everything. So CapEx, I believe you can have a long-term expense plan, whereas OPEX is immediately at the end of the financial year, it hits your book.
Yeah, exactly. So if you think about companies, right, they want to maximize their profit. Like if you have a large expense, like everything you do, end of the day, like if you're a software engineer, the work that you do either translate into OPEX or CAPEX, depending on the type of work. Now, companies care about CAPEX because then you can keep it off your income statement, like you kind of capitalize it into your balance sheet, categorize it as an asset, and then amortize it or depreciate it. That means, like Sean, you said, like charge it over a long period of time. So your profitability doesn't get hit on the same year as when you spend a lot of money, right? OPEX is like type of work, like recurring kind of work that would directly get charged to your income statement. So your profits would come down. And as you know, CEOs, like if you're in the C-suite, like you're measured by how well the company's profitability is doing. So that's why, OPEX and CAPEX matters. And I think what's important to understand is that everything you do, right, every code you write could be translated into a OPEX or a CAPEX, right? So that's why they care about. And, they pay your salaries and it matters for the company CFO.
Quick question, Asanka, Professor. There are some expense that there are some capex rule, right? What can be capitalizable expense versus what is not. I believe like things like program management, administrative work, there are some rules that you can't capitalize on it. Is that true?
That's true. So there, depending on kind of industry, depending on your country, there are different accounting standard. America, we follow GAAP standard, generally accepted accounting practice, and then there are international accounting standards called IFRS. And then every country has a accounting regulatory body that have their own accounting standards. So depending on which kind of accounting standards you follow, there'll be rules to say what kind of expenses can be capitalized and what kind of expenses cannot be capitalized. So you have engineers, you have engineering principles like architecture principles that you care about. If you're doing agile, there are agile principles, right? So similar to that, there are also accounting principles that you need to have some awareness. One principle is going concern. You're doing accounting on the basis that company is gonna exist for a foreseeable future. It's not going to go into bankruptcy. If it's going into bankruptcy, then you're gonna do your accounting very differently. Then there are concepts like matching principle. Like you want to make sure the expenses that you book are tying to the revenues that you're generating. If you are incurring expenses in advance, then You won't see it in the income statement. That will go move to the balance sheet, right? Right, as an asset. I'm not gonna go through all of them, but you should read up on them.
It's a great point because now I understand sometimes, I work with different contracting companies, right? So sometimes when they don't send the invoices on time, or sometimes they get delayed for a couple of months, then I start seeing in the accounting accrual charges for previous month. So you're saying that means, 2 months down the line, if we got the invoice late, they wanted to make sure that cost goes back to where they belong, right? Which month?
Exactly.
And that's why the accrual credit and debit happen.
Yeah.
I
So let's
learned
say
something
let's say
new.
like you are doing contracting with a contracting company. You did some work, let's say in the month of December. Their financial year run from January 1st to December 31st. But you have not paid them, let's say until next year January. Like they have not physically received check from you. And let's say you did work for like $10,000. They still have to recognize that as income, although they haven't received the check for that year where it was applicable, because they actually did the work and they billed you for that year, so that they have to recognize that income for that year. Because you didn't pay the money until January, it's gonna go into their balance sheet as account receivable. Once you pay it, they'll set it off against that. Does that make sense?
Yeah, totally. And I wanted to tell the audience, like, if you ever fret about submitting your timesheet on time, this is what goes behind, right? People pest around saying, hey, did you submit the timesheet? It's the end of the month. We understand now that all of that timesheet translate into accounting, right? They sometimes split budget versus actual spend based on the hours you put in. So all of that comes into picture. Am I right, Asanka?
Yeah, exactly. So that all matters for the company. All right. So if you're a software engineer, how should you think about accounting statement? There are three type of main accounting statements. There is the income statement, also referred to as profit and loss statement in some countries. And then there is the balance sheet. And then there's the cash flow statement. These are almost like the Grafana dashboard for a software engineer. Those are the operational metrics. Talks about the health of the company. Think of that way. That's why it matters. So let's do a quick round robin, maybe. Like, what is an income statement? Like, don't think about a company like you have income statement. So, Roshar, what's in your income? Not the numbers. I know they're really big. But what is typically in an income statement for
Oh
you?
my God, he's putting us on hot seat here, right, Roshan?
My paycheck, right? Any interest I get, perhaps, from investments.
Yes, that's correct.
My son does dog walking, so he gets paid for that. That's part of my income, I guess. Yeah.
Yeah. So if you're providing any services, you get paid for that, right? That's your income, right? So that's the first line. And when you make an income, you are also incurring an expense. If you are, let's say, a manufacturing company, if you're making cereal, if you're making bagels, anything to manufacture, you need labor, you need people, you need material. So those are called cost of goods sold, like that's the technical term, but
Mm.
that is the cost to manufacture the goods that you're selling. And the difference between those two are referred to as the gross profit margin. You hear this all the time.
Mm.
And then below that are your operating expenses. So operating expenses are your general administration expenses, what you pay for your employees. And then you have your marketing expenses. If your company has assets, we spoke about amortizing it. So when you depreciate, get charged as an operational expense. And that gives you net profits. And there are different type of net profits in a company. People like to call it out. If you have borrowed money, then you have interest that you have to pay. So that's then you reduce the interest, then you call it net profit after interest. The one before that is net profit before interest. Very simple.
Mm.
Then you have taxes you have to pay. So you have paid your general expenses, you have paid your employees, you have charged your depreciation, you have paid your taxes, you have paid your interest. So that is the real net profit the company has generated. And who owns that profit? It's owned by the shareholders. That's when you talk about share price, you always talk about EPS. Why do you care about EPS? Because EPS is nothing but your net profit divided by number of shares the company has issued.
I see. Asanka, question. So when they say top line, it affects the top line versus the bottom line. Is the bottom line this net profit?
Exactly.
And the top line is the gross profit that you just mentioned.
Top line, usually people could refer to as the revenue part of it. Like
Okay,
top line impact is the revenue. Bottom line impact is the profit.
got it.
Is the
Uh,
top line what they typically refer to as EBITDA? Like, why is so focused on EBITDA? Like everybody talks about EBITDA. What's so special about it?
Yeah, so EBITDA is earnings, same as profit. Earnings. B is before interest, tax,
I
and
see.
dividend,
I see.
right? So that's like a key number, but that talk to the operational efficiency of the company, right? Because you're thinking about like how much earnings or profits you have generated before you paid your interest,
Okay,
before
got it.
you paid your dividends, before you paid your taxes.
Mm.
As you progress up to become an engineering leader, the EBITDA matters a lot because that is where they'll compare year over year. How are we improving efficiencies as an operational team, right?
Yeah, absolutely, right? Because you don't have control over the amount of debt the company has taken and therefore the interest that you pay. Or you don't have a control over the taxes or the dividends because that's the decision made by the company or the board of directors. What you have control over is the operational efficiency of the company. So that's why the EBITDA matters a lot as a engineer or operational manager.
This is why there's a lot of focus on reducing the COGS aspect, right? Okay, got it. Got it. Makes sense.
Let's switch gears to balance sheet. Why does balance sheet matter? But what is in the balance sheet? Balance sheet is nothing more than really your assets, liabilities, and shareholders' equity. And it's a balance sheet because it balances all the time. There is a formula. The total assets of a company should equal to the shareholders' equity plus the liabilities. That's like a standard formula, and balance sheet always balances. And there are things that can impact balance sheet. There are things that may not impact balance sheet depending on the type of activity. So to go through like a very simply, if you're starting a company day one, right? Let's say, Sean, you're starting up a new company. What do you need? You have an idea. You want to get started. You have a company incorporated.
I need plants, like
Yes.
to manufacture stuff. I'll need workers, basically, and then I need materials, or else I need transportation
Yeah. So you need
and
all that.
land. Yeah.
But to get started, you need to invest some money.
Yes.
So that is your equity. So the moment you bring company, that's called shareholders equity. So that's one part
Got
of
it.
the balance sheet. So it has to balance, right? So you put that on the shareholders equity, then the cash go on the asset side. Right? So it always has to match, right? So shareholders equity considers like how can I say this? I don't want to confuse people. Considers like on the one side of the balance sheet, asset is on the other side of the balance sheet. So it will go on the two sides of the balance sheet. Think of it like a formula. And then there are so those are the assets, and then there are liabilities, right? What are liabilities? Sean, you don't have enough money, then you would go to a bank and get a loan. So it's not equity, it's debt.
That's true.
Then what that would do is it would increase your liabilities. So liability side goes up,
But cash goes up too, right?
cash goes up, so it balances, right? Same thing. Shareholders equity also has a liability. Okay, I know it kind of doesn't make sense when you think about it, but for the purpose of balance sheet, think of it as on the balance sheet side. And then balance sheet has like different categories of assets. We categorize assets into two categories. One is called like fixed assets, like long-term assets, like your buildings, manufacturing plants, things like that. And then you have what is called current assets. Current assets are assets has higher liquidity, like you can turn change into cash in a shorter period of time. So those are cash, inventory,
Raw materials.
raw material, things like that. So that
What
those are the
about
two types of.
receivables?
What's that? So receivable is what we spoke about earlier, like
Someone has to.
somebody has to
Someone
pay
owes you money. Yeah.
or was money. And then the liability is the same thing again. There are long-term liabilities and there are short-term liabilities. Very simple. Long-term liabilities are if you issue like a bond, like you have to pay over more than a year, right? So that's a long-term liability. the opposite of a receivable is payable, right? So if you have a payable, that's short term. So that would be a short term liability.
So in case of you are a software provider company and you have subscription, right? So how would you account for subscriptions that you already know they're going to pay or locked in to pay?
Okay, so that's a great question. So let's think about it. I spoke about at the very beginning, there are some accounting principles like matching principle and accrual principles. Let's say you have subscribed for a company for certain service. Let's say a subscription is a monthly recurring subscription. In that case, company can only recognize subscription once for the service it has provided.
So even if they pay for the whole year, we accrue by the month. Is that right?
On the revenue statement. Let's say you
On the
paid for the
revenue.
entire year. That's a very good
Yeah.
example. Let's say you paid for the
Right.
entire year.
Yeah.
And you are making March 31st account statements, but you have paid from Jan to December 31st. And let's say it's $100 a month. So you have paid $1,200 on January 1st. On the March 31st statements, you can only recognize $300 as your revenue because you have only provided services for 3 months. You haven't provided services for the other 9 months. So you have to actually have provided that service. And the balance 900, as a company, you are liable to the person who paid it. So that would be an account payable in your balance sheet.
That's interesting. So even if your policies say you cannot cancel in the middle and pull the money out, for accounting purposes, we stay true to the service rendered, and anything beyond that is still liability.
Well, if you say you pay $1,000 and then you can't cancel it, like you have paid it outright, then company can recognize the revenue.
Oh, you can. Okay. Okay.
But if it is like a month, like you have paid in advance, that's different, right? Because in this case, you paid $1,000, even whether you use it for a day or use it for 3 months or 9 months, it's $1,000. It doesn't matter. So basically, company has earned the money. That's not associated with it.
Makes sense. Thank you.
And then the other most important statement is called the cash flow statement. Like this is very important financial statement that people often overlook because we only talk about profits. Cash flow statement really explain, like, from your operations, are you actually generating real cash, right? If you think about a lot of these tech companies, they have tons of cash, unlike the manufacturing companies, because their services are really cash-based services. If you look at a cash statement, there are different sections in a cash statement. There are called cash flows from operating activities. That means from your everyday business, how much cash are you making? And then there are cash flows from your investment activities. You can make cash by issuing shares.
Is it also fair to say some of the startup like unicorns, right? They have ton of funding from seed funding and others, like they are continuously burning month over month. And does that help in the cash flow that we can actually see, okay, they are also burning, but at the same time they're getting some revenue to offset? Is there a benefit in looking at cash flow in such a company to see, is it really going to be profitable over time, or is that the wrong statement to look at for that?
I mean, when it's come to startups, like it's very different. Like they probably wouldn't have a lot of cash being generated. They likely are also running at a loss. But if it is an established company, then it makes sense to look at the cash flow statement to see, is it really generating healthy cash flow from the established business. Startups always run on the promise of something big, so they are priced very differently. I don't think I'm the right person to talk about how they should be looked at.
Gotcha. Yeah, I heard someone say that a financial statement of 10K tells a lot of story about the company without even knowing what it does. Like there are so many hidden things there. How are they doing debt financing, and what sort of things they're investing on? All of that is in one statement. Is that true?
That's very true, right? I mean, just like when you look at a Grafana dashboard, it tells you a lot about your platform, right? Your applications. You guys just look at it. Like if you're an engineer, like you understand like exactly what it means.
You can
So
geek out.
yeah, exactly. It's the same thing with the financial statement.
As long as you know what you're looking at. I
Yeah.
mean, for a long time, like it's like Greek to me. Unless you kind of use like AI to tell a story with a 10K, it probably will start make sense.
I think the last part I want to talk about is there's also the financial ratios. So we talk about like gross margin, profitability, ROI. We always talk about ROI. What is ROI,
Return on investment, yeah.
right?
In that, if you are having too much asset, but only some are getting sold, that indicates you are paying too much on the inventory. You're not using your asset, moving your asset enough. Is that right?
So when you talk about asset turnover, Sean, it's really like the fixed assets, not your.
Fixed assets. Okay.
Yes.
So, yeah, how much investment you have done on your fixed asset to generate this much sale, kind of.
Yes, and then how efficient are your assets in generating uh, re- revenue,
Gotcha. Okay.
right? So for every asset you have invested, how much dollars are you generating? Think of that,
Right.
right? So that's also called inventory turnover, what you said, right? So that's about like how many times are you turning around your inventory into sales.
Mm.
So so that's another ratio. So going back to this ROE actually. So first one is I said revenue over assets. That's what we spoke about. Times profitability. So profitability is net income over revenue. So if you think about it, like if you think about it like revenue divided by assets time net income divided by revenue, then the revenue get cancelled off. Then what you are left it with is asset over equity. That's the ROE, right? So that's why like this was like invented or discovered by DuPont, and the story is like they were able to have a like advantage in the marketplace because they looked at their financial statement very differently than other companies. But these ratios are important because if you're trying to compare two companies, that you can really look at and see, okay, which company is better than the other company. If they're in the same industry, doing the same kind of work, some company might have better ratios. That means they are run better.
There's another ratio also that comes for public companies like PE ratio. Is that something like that as well, or is different?
Yeah, so it's a very market driven ratio. So we spoke about earnings per share. So PE ratio is basically the market price or the share price divided by EPS or the earnings per share. So it's a multiplier. It tells like what is the multiple that the company is trading at relative to its EPS,
I see.
right? So you can see some companies are having higher PE ratio versus some companies are having lower PE ratio. Let's say it could be the same industry doing the same business. But why is that?
Is it is it a indicator of like an overvalued stock then, for example?
That could be one reason. Like some companies could be overvalued. That could be a reason. But some could, but companies sustain that overvaluation. But why is that? Like they're doing the same thing, same kind of products. Could be two car companies. One companies have a higher PE multiplier because the market thinks this company has higher potential than the other company. Therefore, we should value it better. Like Tesla is a good example. Like if you look up Tesla's PE ratio, like I think it's like very high. I don't remember the number. Uh, so that's the reason.
Very cool.
From a audience perspective, Asanka, like, can we? I know we are over time. Can we cover some things like how do companies invest in projects, right? So initially, I think businesses propose ideas to CFO, saying, okay, this is the idea that I want money for, and this is the IRR or internal rate of return, and these are the features I'm hoping. This is how much it's going to generate revenue. So there's like few statistics that they pass, and then when the CFO approves it, then it becomes a cost center that every resource who is working in the project have to charge that. Can you talk about that? Because that might be useful for the audience here so that they understand how this investment works.
Yeah, I mean, these investment decisions can be made like it very multiple reasons, but just sticking to the finance topic because I think investment decision can be driven by what they see as the potential in the market, could be driven by what competitors do. You brought up like another very important ratio like IRR, right? What is IRR, right? The internal rate return, internal rate of return, right? So if you, because when you are investing, you are going to spend so much cash over a period of time, and cash has alternative use, right? Should I invest in this project, right? Or I can put money somewhere else,
Like a
right?
bond, like guaranteed
Yeah, I
return.
can put money in a bond and maybe earn 4%. So company has what is called like cost of capital. How does it cost for it to spend like that cash? So you discount it based on the projected cash flow from a project or the amount of money that you're going to spend over the next 5 years. So if IRR is higher, that means you're getting a better internal rate of return. And another associated one is the NPV, like net present value. Again, you discount it by a certain cost of capital, and whichever the project that has higher NPV is a better project. Similarly, some companies look at another method called payback period. Like it's the most simplest form. If I invest, let's say, $1 million, like how soon will I get my $1 million back? Like payback period, right? But it doesn't take time value into consideration. Like IRR and NPV take time value into consideration because money today is worth more than money tomorrow.
Yeah, those days we used to do it by hand, but now in Excel you have function you can just call NPV and put in a value of like a future value you are expecting to get like 15 years from now, and it'll calculate the net present value, which is what NPV stands for. So you can actually compare multiple investment options to pick the right one. But you're right, a payback period was like a bad way to do it because a lot of investment were discounted thinking that it had a longer payback period, but it didn't take the trajectory into account, right? The growth potential. Yeah,
So there's
interesting
a
topic.
lot people can learn from this. If you are a software engineer, like you should look at your annual report. Annual report is something that each company publish. If it's a public company, you publish like every year, so you should read through and understand like how does your company make revenue. Like everyone should understand that, and there would be like a chairman's report or a CEO's report with the annual report that's published. You should read that. That gives a lot of information about the company's vision, strategy, like. And then with this accounting statement, they also publish what is called like accounting notes. Like a lot of people don't look at those, but if you look at those, like you'll find a lot of insightful information. These are things that you should look at in your company annual statement.
But just a quick note. So if you are public, you have to release your financial statement quarterly, right? Or is it annually?
Yeah, so you again, like depending on the
In the US.
jurisdiction,
Yeah.
you might have different rules, but in the US, you have to file 10K and 10Q, right? 10Q is quarterly and 10K is the annual report.
I will do that right after this.
There you go.
If you're working for a private company, good luck. those those statements are not readily available for public consumption. That's why it's called private. But
Or if you have a competitor that is a public company, then you
mm,
can read their financial statement because very likely you run a similar business.
That's so true.
it's an excellent episode. I learned a lot of things, like Roshan said. Thank you,
Yeah.
Asank.
Thank you, Asanka. This is very educational. Thank you.
I know I did a lot of talking in this one, but yeah.
No, this is good. This was like a lesson, actually.
It's important for us to learn about this before we spend on Christmas shopping. So
Yeah,
thank you.
cool. Maybe we wrap up there.
Let's wrap it up and also wish our listeners happy holidays and Merry Christmas and Happy New Year too.
Yeah. Happy holidays.
Happy holidays. Stay
Merry
safe.
Christmas. Happy New Year.
Bye bye.